Yeah, no, I love this problem because it's a messy problem, right? Let's be honest here. It's a fragmented market where you like you said at the beginning, location really matters. So it's not like you can use a necessarily a top down systematic approach to get you in and out of markets or in the right exposures in the real estate market. You obviously need to do a lot more
Yeah.
due diligence at the investment level. But what I'm hearing just from a broader thesis, and correct me if I'm wrong, but I'm hearing that the proper trade here is short regional banks and long everything else, because ultimately we understand that this is probably not going to be a systemic issue. Visa, certainly not unlikely to be a systemic issue like what we saw in 2008, 2009, for two reasons. One, we don't see the leverage profile in the financial sector. We don't have the kind of credit gap metrics or the adverse selection metrics that you would typically see into a financial crisis type event. And this is something that's consistent across all major economies. We don't have those kind of vulnerabilities in this current cycle. And secondarily, these assets aren't like publicly traded in all any of these major vehicles where the investors are going to have to wind up selling what they don't want to sell in order to meet or fund redemptions and what's causing the fund to go down. So I don't see broad systemic risk, but obviously it seems there's a lot of risk for the lenders that are exposed into these particular markets.